Before we begin, please note that the information in this presentation is for educational and informational purposes only. I am not a licensed financial advisor or insurance agent. This video is not a substitute for professional financial or legal advice. Always consult with a qualified professional before making any decisions about your insurance coverage. Your individual needs and circumstances are unique, and the strategies discussed here may not be suitable for everyone. Last month, a friend of mine, let's call her Jessica, got her auto insurance renewal in the mail. She has a perfect driving record. Not a single ticket, not one accident in over a decade. She drives a sensible 4-year-old SUV. She opened the envelope, expecting the usual small increase, but her jaw hit the floor. Her 6-month premium had jumped by 42%. For the exact same coverage. No changes. No claims. Nothing. She felt completely powerless, like she was being taken advantage of. And the worst part is she's not alone. This is happening to millions of Americans right now. And it's about to get even worse as we head into 2026. You are being systematically overcharged for your car insurance. It's not your fault. The entire system is engineered to extract the maximum amount of money from your bank account. And it's built on a foundation of outdated advice and carefully crafted myths. But that ends today. This video is your playbook. It's the step-by-step guide to fighting back, taking control, and cutting your insurance bill by hundreds, maybe even thousands, of dollars a year without sacrificing a single drop of coverage. We are going to dismantle the entire process piece by piece and rebuild it in your favor. By the end of this, you won't just be a consumer. You will be an expert negotiator in your own financial life. So why is this happening? Why does it feel like your insurance bill is a runaway train? It's not just in your head. There are 3 massive forces colliding right now, creating a perfect storm for skyrocketing rates. First, and most obviously, is inflation, but on a level we haven't seen in the auto industry before. The cars we drive today are not the simple machines they were 10 years ago. They are rolling supercomputers. That tiny sensor in your bumper that enables blind spot monitoring? A minor fender bender that used to be a $1,000 fix can now easily cost $5,000 because that sensor needs to be replaced and, more importantly, recalibrated with specialized equipment. The cost of parts, especially for electric vehicles and cars loaded with advanced driver assistance systems, has exploded. Add to that a shortage of qualified mechanics, which drives up labor costs, and you can see why the average cost of a vehicle repair has gone through the roof. Every time you hear about these rising costs, remember, the insurance company isn't eating that cost. They are passing it directly on to you in the form of higher premiums. The second force is the spiraling cost of medical care. When there's an accident with injuries, a huge portion of the insurance payout goes to medical bills. And as healthcare costs in the United States continue to climb, so does the amount the insurance company has to reserve for potential injury claims. That bodily injury liability line item on your policy? It's directly tied to the cost of an emergency room visit, physical therapy, and hospital stays. So even if you're the safest driver in the world, the rising cost of healthcare for everyone else is directly inflating your personal insurance bill. And the third, more hidden factor, is a combination of increasingly severe weather and a more aggressive legal environment. We're seeing more catastrophic weather events. Hailstorms that damage thousands of cars at once, flash floods that turn entire car lots into junkyards, hurricanes that cause widespread devastation. These massive, multi-million-dollar events are happening more frequently, and insurers are spreading those costs across their entire customer base, no matter where you live. At the same time, we're seeing a trend of what the industry calls nuclear verdicts, where lawsuits resulting from accidents lead to staggeringly high multi-million-dollar jury awards. Insurers are terrified of these verdicts, so they build that risk into the price they charge everyone. Now, hearing all that, it's easy to feel defeated. It sounds like all the forces are against you, and that's exactly what the insurance companies want you to feel. They want you to feel like high rates are inevitable, like you have no choice but to just accept your renewal and pay it. But that is a lie. The single biggest mistake you can make is believing you are powerless. The truth is, you hold more power than you realize, but only if you're willing to change your mindset. You have to stop thinking like a loyal customer and start thinking like a savvy free agent. This brings us to the very first, and perhaps most costly myth we need to shatter right now. The myth that loyalty is rewarded. For decades, we've been conditioned to believe this. We see the commercials. We've been with Acme Insurance for 20 years, they're like family. We get that little loyal customer discount on our statement, maybe for $10 or $15, and we feel valued. It's a psychological trick, and it's costing you a fortune. In the insurance world, there's a quiet, controversial practice known as price optimization. Some call it a loyalty tax. Here's how it works. Insurance companies use incredibly sophisticated data analysis to predict your behavior. They know how long you've been a customer, whether you bundle your policies, and most importantly, they analyze your shopping habits. They build a profile on you to determine your price elasticity, which is a fancy way of asking, how much can we raise this person's rate before they'll actually go through the hassle of switching? If their data suggests you're a sticky customer, someone who is unlikely to shop around, your rates will slowly, almost imperceptibly, creep up year after year, far beyond what's justified by risk alone. That little loyalty discount they give you? It's often a smokescreen to distract you from the fact that your base rate has been inflated by hundreds of dollars over the years. They are rewarding your loyalty with a penalty. They are betting on your inertia. They are betting you won't make the call, that you won't click the link, that you'll just sigh and pay the bill. Think of it this way. You walk into a store to buy a new television. The price tag says $1,000. But the salesman, using a secret computer, knows you've bought your last 3 TVs from this exact store. So, for you, he changes the price to $1,200. But to make you feel good, he says, because you're a loyal customer, I'll give you a $50 discount. You walk out paying $1,150, feeling like you got a deal, when a brand new customer off the street just walked out with the exact same television for $1,000. That is what is happening with your insurance. The new rule for 2026 is simple. Your loyalty is a liability. The moment you decide to become a permanent free agent is the moment you take back all the power. It means your business is always up for grabs, available to the company that provides the best possible coverage for the absolute best price. It means you force them to treat you like a brand new, highly sought-after customer every single year. This mindset shift is the foundation of everything we are going to build on. It's the key that unlocks all the other savings. We've just torn down the myth of loyalty, but this is just the first domino to fall. Believing all insurance companies are the same is an even bigger mistake, and understanding the hidden differences between them is where the truly massive savings are found. Think about it. You turn on your TV, and within an hour, you're hit with a gecko, a quirky woman named Flo, a guy in a suit promising you're in good hands, and maybe even a former NBA star. Feels like you have endless choices. But this is the great illusion of the auto insurance industry. While there are hundreds of carriers in the United States, they aren't all playing the same game. In fact, most of them fall into one of 3 distinct categories. And if you don't know which category you should be shopping in, you're essentially playing darts in the dark, hoping to hit a bullseye you can't even see. Let's call these categories the giants, the specialists, and the disruptors. Understanding the DNA of each one is the key to unlocking savings you never thought possible. First, you have the giants. These are the household names, the titans of the industry: Progressive, Geico, State Farm, Allstate. They spend billions, literally with a B, on advertising every single year to make sure their name is the first one that pops into your head. Their business model is built on one word: scale. They want to be everything to everyone. They want your car, your house, your boat, your RV, your life insurance. Everything. The primary advantage of the giants is convenience and bundling. They've made it incredibly easy to manage all your policies under one roof. And they'll offer you a discount for doing so, the famous multi-policy or bundling discount. For a lot of people, this seems like a no-brainer. One bill, one company, one app, plus a discount. Sign me up. And for some, particularly those with multiple homes, several cars, and a perfect driving record, this can actually be a good deal. The giants have deep pockets, they are financially stable, and you can be confident they'll be around to pay a claim. But here's the multi-billion-dollar secret they don't want you to focus on. That bundling discount can be a Trojan horse. They might give you a 15% discount for bringing over your home insurance, but what if their base rate for your auto policy was already 30% higher than another company's? You feel like you're winning because you got a discount, but in reality, you're still overpaying by a huge margin. They count on you being too busy to check. They use the convenience of the bundle as a golden cage. You feel safe and secure, but you're trapped in a higher-priced ecosystem. The giants are the Walmart of insurance. They have everything you need, and the prices seem low. But a savvy shopper knows you can often find better quality and better prices for specific items at other stores. For them, you are a number, a data point in a massive algorithm. If your specific risk profile doesn't fit perfectly into their most profitable box, you'll pay a premium for it. This brings us to our second category, the specialists. These are the hidden gems of the insurance world. They don't try to be everything to everyone. Instead, they focus with laser-like precision on one specific group of people. And because they do, they can often offer rates that the giants simply cannot touch. The most famous example is USAA. They cater exclusively to military members, veterans, and their families. Why can they offer such competitive rates? Because their pool of customers is, on average, a lower risk. They have a deep understanding of the unique lifestyle and risk factors of military families. They're not trying to balance out that risk with teenage drivers in sports cars or city dwellers with long commutes. By focusing on a single reliable demographic, they can fine-tune their pricing model to an incredible degree. If you are eligible for USAA and you haven't gotten a quote from them, you are almost certainly leaving a significant amount of money on the table. It's that simple. But it's not just USAA. There are specialists for all sorts of groups. The Hartford has a long-standing partnership with AARP, offering special rates and benefits to people over 50. Chubb and AIG Private Client Group specialize in high-net-worth individuals, offering policies that cover exotic cars, art collections, and unique liability situations that a standard carrier wouldn't even know how to handle. There are carriers that specialize in classic cars, like Haggerty. There are even some that focus on specific professions like teachers or engineers, who statistically have lower accident rates. The downside? You have to be in their club. You can't just decide you want to join USAA. But the lesson here is crucial. You need to ask yourself, is there a company that specializes in people like me? A quick search for auto insurance for teachers or auto insurance for AARP members can uncover companies you've never heard of that are literally designed to give you a better deal. The specialists prove that when it comes to insurance, being a small fish in a small, specialized pond is often far more profitable than being a small fish in the giant generic ocean of the big brands. Finally, we have the most exciting and potentially revolutionary category, the disruptors. These are the tech companies that just happen to sell insurance. Think Lemonade, Root, Metromile, and a growing list of others. Their entire philosophy is different from the old guard. They don't have thousands of agents or massive brick-and-mortar offices. They have apps, artificial intelligence, and a whole lot of data. The key innovation that most disruptors bring to the table is something called telematics, or usage-based insurance, UBI. This is the pay-as-you-drive, or pay-how-you-drive model. Instead of judging you on broad, traditional factors like your age, zip code, and credit score, they use technology to see how you actually drive. They use the GPS and motion sensors in your smartphone, or a small device you plug into your car, to track your real-world driving habits. Are you a smooth braker? Do you avoid late-night driving? Do you stick to the speed limit? How many miles do you really drive each month? For safe, low-mileage drivers, this can be a complete game-changer. Why should a person who works from home and drives 3,000 miles a year pay a similar rate to their neighbor, who has a 50-mile commute each way? It doesn't make sense, and the disruptors are capitalizing on that inefficiency. Companies like Root will actually make you download their app and monitor your driving for a few weeks before they even give you a quote. If you're a bad driver, they'll literally refuse to insure you. This allows them to build a customer base of only the safest drivers, which in turn allows them to offer incredibly low rates. The experience is also completely different. Filing a claim can be as simple as opening an app, recording a video of the damage, and letting their AI process it in minutes. It's fast, slick, and designed for a generation that lives on their smartphones. But, and this is a big but, it's not for everyone. The first and most obvious hurdle is privacy. Are you comfortable with an insurance company tracking your every move in your car? Knowing where you go, when you go, and how fast you get there? For some, that's a deal breaker no matter the savings. Secondly, this model is still relatively new. While their AI might be great for a simple fender bender, how does it handle a complex multi-car accident with serious injuries? The traditional claims process with a human adjuster has been refined over a century. The new tech-first model is still proving itself. If you're a cautious, safe driver who values savings over privacy and is comfortable with a tech-centric approach, you absolutely must get quotes from these companies. The potential savings are just too large to ignore. So we have the giants built on scale and convenience, the specialists built on focus and exclusivity, and the disruptors built on technology and data. These aren't just different brand names. They are fundamentally different approaches to insurance. The biggest mistake you can make is only getting quotes from one category. You're leaving a world of savings on the table. Now that you know who to shop with, the next critical step is understanding what you're actually buying. Because choosing the right company is only half the battle. Choosing the wrong coverage can be an even more devastating and costly mistake. And the language of your policy, words like liability, collision, comprehensive, and uninsured motorist, is deliberately confusing. In the next part, we're going to translate it all into plain English. Let's start with the absolute foundation, the one part of your policy that isn't optional: liability. Think of liability coverage as your financial shield. It doesn't protect your car. It doesn't protect you. It protects you from financial ruin when you accidentally hurt someone else or damage their property. Imagine a guy named David. He's a good driver, pays his bills on time, a totally responsible person. He's driving home from work on a Friday, maybe thinking about the weekend. He looks down for just 2 seconds to change a podcast, and in that instant, the car in front of him, a brand new Lexus, slams on its brakes. David hits them. It's not a huge crash, just a fender bender. But this is where the nightmare begins. The driver of the Lexus gets out, rubbing his neck. The bumper is crumpled. A week later, David's insurance gets the bill. The Lexus has sophisticated sensors in its bumper. The repair cost isn't a few $100s. It's $17,000. Then the letter from the other driver's attorney arrives. The sore neck is now a serious spinal injury, requiring months of chiropractic care, physical therapy, and lost wages. The medical claim is $55,000. David isn't worried. He has insurance, right? He pulls out his policy, the one he bought online because it was the cheapest. He has the state minimum liability coverage for Texas, 30/60/25. This is where you need to listen closely because these 3 little numbers are the most important and most misunderstood part of any auto policy. That 30/60/25 stands for $30,000 for bodily injury per person, $60,000 total for bodily injury per accident, and $25,000 for property damage. Let's look at David's crash. The Lexus repair was $17,000. His $25,000 property damage limit covers that. He's safe there. But the medical claim was $55,000. His policy only covers $30,000 per person. Where does the other $25,000 come from? Comes from David. Directly from his savings account, from his paycheck, from his future. His insurance company writes a check for $30,000 and wishes him the best of luck. The other driver's attorney will now come after David personally for the rest. That cheap insurance policy just became the most expensive decision of his life. State minimums are a joke. They were set decades ago when a new car cost $5,000 and a hospital stay was a few $100s. In 2026, hitting a new truck or a luxury SUV can easily cause over $100,000 in damage. A moderate injury can skyrocket past $250,000 in costs. Relying on state minimum liability is like trying to stop a tidal wave with a paper towel. It's financial suicide. So that's liability, it covers the other guy. But what about your car? Let's go back to David. A year later, he's learned his lesson. He has better liability coverage. He's driving a newer car himself now. One winter morning, he hits a patch of black ice, loses control, and slams into a concrete median. The whole front of his car is destroyed. This time, it's clearly his fault. There's no one else to blame. This is where collision coverage comes in. Collision pays to repair or replace your car when you are at fault in an accident with an object or another vehicle. It's what fixes your mess when you make a mistake. But there's a catch: the deductible. The deductible is the amount of money you have to pay out of pocket before the insurance company pays a single dime. Let's say David's car needs $12,000 in repairs. If he has a $1,000 deductible, he pays the body shop the first $1,000, and his insurance covers the remaining $11,000. If he has a $500 deductible, he pays $500, and they pay $11,500. A higher deductible means a lower monthly premium, because you're telling the insurance company you're willing to take on more of the initial risk. A lower deductible means a higher premium, because they're on the hook for more of the cost. Finding the right deductible is a crucial part of our strategy, and we'll get to that. For now, just remember, collision is for when you hit something, and the deductible is your share of the repair bill. But what if you don't hit anything? What if something happens to your car? Picture this: you park your car at a movie theater. You come out 2 hours later and it's gone, stolen. Or a massive hailstorm rolls through your town and turns your car's hood and roof into a golf ball. Or you're driving down a country road at night, and a deer jumps out in front of you. Or a branch from your neighbor's tree snaps off in a windstorm and crushes your windshield. None of these are collisions. You didn't hit another car or an object because of your driving. This is the domain of comprehensive coverage. It's often called other than collision coverage, and it's for all the weird, random acts of God events that can damage or destroy your car. Fire, flood, vandalism, theft, animal strikes. That's all comprehensive. And just like collision, it also has a deductible. You choose how much you're willing to pay first before the insurance kicks in. Most people think liability, collision, and comprehensive are all you need. They think they're fully covered. They are dangerously wrong. There is one more piece of the puzzle, and in my opinion, it is the single most important coverage you can buy to protect yourself and your family. It's called uninsured and underinsured motorist coverage. Let's change the scenario. You're sitting at a red light, patiently waiting for it to turn green. Suddenly, a beat-up sedan barrels through the intersection, runs the red light, and T-bones your driver's side door. The impact is violent. Your car is totaled. Your arm is broken. The other driver speeds off, disappearing into traffic. A hit and run. Who pays for your medical bills? Who pays to replace your car? The other driver was at fault, but they're gone. Your health insurance might cover some of the medical costs, but you'll have co-pays and deductibles. And they certainly won't pay for your lost wages while you can't work. And your collision coverage could fix your car, but you'd still have to pay your deductible, and your rates might go up, all because of a criminal who vanished. This is where uninsured motorist coverage becomes your superhero. It steps in and acts like the insurance the other driver should have had. It will pay for your medical bills, your pain and suffering, and your lost wages. There's even a separate part for property damage that can pay for your car repairs, often with a much lower deductible than your regular collision coverage. It protects you from the ghost driver. But what if the driver doesn't run? What if they pull over and they have insurance? The problem is, they have that same garbage state minimum policy we talked about earlier. Let's say your medical bills are $100,000. Their policy only has a $30,000 limit. Their insurance pays the $30 grand and that's it. You're left with a $70,000 hole. This is where the second part kicks in. Underinsured motorist coverage. Because the other driver was underinsured to cover your costs, your own policy steps in and pays the difference, all the way up to the limits you selected. 1 in every 8 drivers on the road in America right now has no insurance at all. 1 in 8. And of those who do have it, a massive percentage only carry the legal minimum. This means there is a very real chance that the person who hits you will not have the means to pay for the damage they cause. Uninsured and underinsured motorist coverage is not a luxury. It is an absolute necessity. It's a shield that protects you from the financial irresponsibility of others. Finally, there are 2 smaller coverages: medical payments, or MedPay, and personal injury protection, or PIP. Think of these as a pot of money set aside for immediate medical needs. If you're in an accident, regardless of who is at fault, this coverage can instantly pay for your ambulance ride, your ER visit, your health insurance deductible, and do the same for any passengers in your car. It's fast, no questions asked coverage. In some states called no-fault states, a more robust version called PIP is actually required. So let's recap the building blocks. Liability protects your assets when you hurt others. Collision fixes your car when you're at fault. Comprehensive fixes your car from theft, weather, and other random acts. And the most important shield, uninsured and underinsured motorist, protects you when the other driver can't or won't pay. Now you can read an insurance quote and understand what you're actually looking at. You can speak the language. But this is only step 1. Knowing what a wrench is doesn't make you a mechanic. Now we have to learn how to use these tools. How much liability is enough? Is 100/300/100 the right number? Or should you go for 250/500/250? What's the sweet spot for your deductible that saves you money without putting you at risk? In the next part, we're going to build your perfect bulletproof insurance policy number by number, and I'll show you exactly how much coverage you actually need without wasting a single cent. Alright, let's get into the nuts and bolts. We're going to assemble your perfect insurance policy piece by piece. Think of it like building a custom suit of armor for your financial life. We're not just picking something off the rack. We're tailoring it so there are no weak spots. The first, and by far the most important layer of this armor is your liability coverage. This isn't the exciting part, but it is the part that can save you from absolute ruin. Liability is the I messed up coverage. It pays for the damage you cause to other people and their property. If you rear-end a brand new Mercedes or, God forbid, you cause an accident where someone is seriously injured, this is the part of your policy that steps in to pay their medical bills, their lost wages, and their car repairs so you don't have to sell your house to do it. Now you're going to see 3 numbers here. It'll look something like 25/50/25. This is where most people make their first critical mistake. They see their state requires, say, 25/50/25, and they think, great, I'll get that. It's the cheapest option. This is a trap. A devastatingly effective trap. Let me tell you why those state minimums are basically financial suicide. That first number, 25, stands for $25,000. That's the maximum your insurance will pay for any single person's medical bills in an accident you cause. The second number, 50, is $50,000. That's the total maximum they'll pay for everyone's medical bills combined, no matter how many people are in the other car. The third number, 25, is $25,000 for property damage. Now let's play this out. You have a momentary lapse in attention, it happens to everyone, and you run a red light T-boning a minivan. Inside is a family of 4. The driver needs surgery on their knee. One of the kids has a broken arm. Just one ambulance ride and a couple of nights in the hospital can blow past $25,000 faster than you can blink. And that's for just one person. What about the other 3? Your policy maxes out at $50,000 for all of them. Let's say their total medical bills hit $150,000. Where does the other $100,000 come from? Comes from you. They will sue you. And they will win. The courts will look at your savings, your investments, the equity in your home, and they can even garnish your future wages for years, sometimes decades. And we haven't even talked about their car. You hit a brand new minivan. It's totaled. Its value? $45,000. Your policy only covers $25,000 in property damage. So you are personally on the hook for the remaining $20,000 right off the bat. In one split second, with a state minimum policy, you could be facing a bill of over $120,000 that you have to pay out of pocket. Your life has changed forever. This is not a scare tactic. This is the reality of a single moderate accident in 2026. The cost of medical care in vehicles is skyrocketing. State minimums haven't kept up. They're a relic from a bygone era. So what's the answer? The gold standard, the number that most financial advisors recommend to truly protect yourself, is $250/500/100. That's $250,000 per person, $500,000 total for injuries, and $100,000 for property damage. The jump in price for this level of protection is shockingly small compared to the catastrophic risk you're avoiding. If that feels too steep, you should not, under any circumstances, go below $100/300/100. That is your new minimum. That is your line in the sand to protect your future. Okay, so we've covered your liability. Your armor is protecting you from the damage you might cause. But what about when it's not your fault? What happens when someone without insurance, or with one of those worthless state minimum policies, plows into you? 1 in every 8 drivers on the road in America right now is uninsured. 1 in 8. That means every time you're at a busy intersection, chances are you're looking at someone with no insurance at all. This is where the second, criminally underrated piece of your armor comes in: uninsured and underinsured motorist coverage, or UM/UIM. This is the protect me from other people's irresponsibility coverage. If an uninsured driver hits you and puts you in the hospital, this coverage acts like their liability policy, paying for your medical bills and your lost wages. The underinsured part is just as important. Let's say someone with a trashy 25/50/25 policy causes an accident that results in your medical bills being $100,000. Their policy pays the first $25,000, and then your underinsured motorist coverage kicks in to help cover the remaining $75,000. Without it, you'd be suing a person who clearly has no money to begin with. It's a pointless, draining exercise. You should always match your UM/UIM coverage to your liability coverage. If you have $100/300 in liability, you get $100/300 in UM/UIM. It's that simple. It's incredibly cheap for the peace of mind it provides. And in some states it's required, but often at levels that are far too low. Don't skimp here. This is you betting on yourself. Now for the final major pieces of the puzzle: collision and comprehensive. These are the two that actually fix your car. It's amazing how many people confuse them, but it's simple. Collision covers your car when it collides with something. Another car, a pole, a guardrail, a garage door. It doesn't matter whose fault it is. If you collide with an object, this is your coverage. Comprehensive is for almost everything else. Think of it as the acts of God and weird stuff coverage. A tree falls on your car. A hailstorm makes it look like a golf ball. It gets stolen. You hit a deer on a back road. A rock flies up on the highway and cracks your windshield. All of that is comprehensive. Here's the rule for these two. If you have a loan or a lease on your car, the bank requires you to have both. You have no choice. But if you own your car outright, you get to decide. And the decision comes down to a simple formula, the 10% rule. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's current cash value, it's time to seriously consider dropping them. For example, if you're driving a 15-year-old sedan that's worth maybe $2,000, but you're paying $500 a year for collision and comprehensive, you're lighting money on fire. In 4 years, you'll have paid the insurance company the entire value of your car. It makes no sense. Instead, drop the coverage, take that $500 you're saving, and put it into a separate savings account earmarked for car repair or replacement. This is also where we have to talk about your deductible. The deductible is the amount you pay out of pocket before the insurance company pays a dime. For collision and comprehensive, you'll choose a deductible, usually between $250 and $2,000. Here's the secret. The higher your deductible, the lower your premium will be. Raising your deductible from $500 to $1,000 can save you 15 to 30% on that portion of your premium. The golden rule for choosing a deductible is this. Never choose an amount you couldn't pay in cash tomorrow without breaking a sweat. If a $1,000 surprise bill would send you into a panic, then a $1,000 deductible is not for you. Stick to $500. But if you have a healthy emergency fund, raising it to $1,000 is one of the smartest and easiest ways to save money. So, let's recap the core of your bulletproof policy. Liability at a minimum of 100/300/100. Uninsured motorist coverage that mirrors that number. And collision and comprehensive with a smart deductible, but only if your car's value justifies the cost. Get these 3 things right and you've built a fortress around your finances. But we're not done. There are a few lesser-known, optional coverages that can be absolute lifesavers, and in some cases they cost as little as a cup of coffee per month. And then we'll get to the fun part, the discounts. Stacking discounts is how we take a good rate and make it an unbeatable one. And I've found over a dozen of them that most people don't even know exist. That's all coming up next. Alright, let's talk about stacking. Think of it like a game. The insurance company sets the price, and your job is to chip away at it, piece by piece, using every tool at your disposal. Most people find 1 or 2 discounts and stop. They get their multi-policy discount, maybe a good driver discount, and they think they've won. But that's like finding a couple of loose dollars on the sidewalk and walking past a bag of cash. We're going for the bag of cash. Every discount is a building block. One block might be small, just a few bucks a month. But you stack 5, 10, 15 of these blocks on top of each other, and suddenly you've built a tower of savings that slashes your premium by hundreds, even thousands of dollars a year. So where do we start? We start with the foundation. These are the big 3 discounts that almost every carrier offers. They're the easiest to get, and you should consider them non-negotiable. First is the multi-policy discount, also known as bundling. This is the low-hanging fruit. You have auto insurance, but you also have homeowners, renters, or maybe even life insurance. By placing them all with the same company, you're making their life easier, and they reward you for it. This discount is often one of the biggest, frequently in the 10 to 25% range. If you have your policies scattered across different companies, you are almost certainly leaving a significant amount of money on the table. Make a list of all your insurance policies right now. If they're not with the same provider, your first call should be to get quotes for bundling them all. Second is the multi-car discount. Another straightforward one. If your household has more than one vehicle, they should be on the same policy. Insuring 2 cars together is cheaper than insuring them on 2 separate policies. The logic for the insurer is simple. They get more of your business, and households with multiple cars often represent a more stable, lower risk profile. Third is the good driver discount. Now, this sounds vague, but it has a very specific meaning. This is your reward for being a safe, responsible driver. Typically, this means you've had no at-fault accidents, no major moving violations like a DUI or reckless driving, and no more than 1 minor ticket in the last 3 to 5 years. This period is called the look-back period. The discount can be substantial, often up to 20 or 30%. This is the one you earn every single day by driving safely. It's a direct reflection of your personal risk. If you have a clean record, you must ensure you are getting the maximum credit for it. Okay, that's the foundation. The big three. Most people stop there. We are just getting started. Now we move to the next layer, your vehicle. The car you drive is a treasure trove of hidden discounts. Let's start with safety features. Does your car have anti-lock brakes? That's a discount. Does it have daytime running lights? That's a discount. Does it have airbags, and not just the front ones but side curtain airbags too? That's a discount. Many of these features have been standard for years, but not all insurers automatically apply the discount. You have to ask. Then there's the anti-theft discount. This is a big one. It's split into two categories: passive and active. A passive device is something that works automatically, like an engine immobilizer that prevents the car from being hotwired. If your key has a chip in it, you likely have one. An active device is something you have to turn on, like a car alarm or a tracking system like LoJack. Active systems often get you a bigger discount because they can help police recover a stolen vehicle, saving the insurance company a total loss payout. Check your car's manual, see what systems you have, and declare them. Here's one people miss: the new car discount. If your car is less than 3 years old, many companies will give you a discount of up to 10%. They do this because newer cars are considered more reliable, have more advanced safety features, and are less likely to break down in a way that could cause an accident. And in 2026, this is becoming more and more common: the green vehicle or eco-friendly discount. If you drive a hybrid or a fully electric vehicle, you could be eligible for a discount. Insurers are starting to recognize that the drivers of these vehicles often have a safer, more conscientious driving profile. So your EV or hybrid isn't just saving you money on gas. It should be saving you money on insurance too. So we've stacked the big three and the vehicle discounts. Now let's get personal. The next layer of discounts is all about you, your habits, your profession, and your affiliations. First up, for the younger drivers or families with them, the good student discount. If you or a driver on your policy is a full-time high school or college student, and they maintain a B average or a 3.0 GPA, you can get a serious discount, sometimes as high as 25%. Why? Because insurance companies have mountains of data that show a statistical correlation between academic responsibility and driving responsibility. You need to send in a report card or transcript once or twice a year. But for that kind of savings, it's absolutely worth it. Next is one of my favorite proactive discounts: the defensive driving course discount. This is an absolute game changer. Most states have approved online defensive driving courses. You sign up, pay a small fee, maybe $20 or $30, and spend a few hours completing the course online. When you're done, you get a certificate. You send that certificate to your insurance company, and they can knock 5 to 10% off your premium for 3 solid years. Let's do the math. Your premium is $1,800 a year. A 10% discount is $180 a year. Over 3 years, that's $540 in savings for a $30 course you took one Saturday afternoon. That is an incredible return on investment. Now for the one that is pure insider knowledge: affinity and professional discounts. Insurance companies make deals with large organizations, employers, and associations to offer special rates to their members. This is a massive, often untapped source of savings. Are you a teacher, a firefighter, a police officer, or a nurse? There are discounts for you. Are you an engineer or a scientist? There are discounts for you. Are you active duty military or a veteran? There are huge discounts for you. A federal government employee? There's a discount. But it goes deeper. Are you a member of an alumni association from your university? A member of a specific fraternity or sorority? A member of a credit union? A member of a wholesale club like Costco or Sam's Club? All of these can unlock a group rate that isn't available to the general public. Sit down and make a list of every single group, organization, and association you belong to. When you're getting quotes, you need to ask the agent, do you offer an affinity discount for members of? And then list them. You will be shocked at what you find. Finally, we have the simple administrative discounts, the policy and payment hacks. These are the easiest of all. Paperless billing. Agree to receive your bills and documents via email instead of snail mail. It saves the company printing and postage costs, and they pass a small discount on to you. It's usually just a few dollars a month, but remember, we are stacking. Paid in full discount. This is a big one. Instead of paying your premium monthly, if you can afford to pay the entire 6-month or 1-year premium all at once, you can often get a significant discount, typically between 5 and 10%. The insurer gets all their money up front, which eliminates the risk of you missing a payment. They reward you handsomely for that. Automatic payments. If you can't pay in full, the next best thing is to set up automatic payments from your checking account or credit card. This is often called an EFT, or electronic funds transfer discount. It's not as big as the paid-in-full discount, but it still adds another small block to our savings tower. So look at what we've done. We started with the big three. We added discounts for our car's safety features. We layered on discounts for being a good student, a safe driver, and a member of a specific profession. And we topped it off with discounts for how we pay our bill. This is how you take a quote and systematically dismantle it. But there's one more critical piece to this puzzle. It's a trap that millions of people fall into, and it costs them a fortune. It's the myth of the loyalty discount, and understanding how it's secretly working against you is the key to unlocking the final, and often largest, layer of savings. We'll expose that next. It's a concept so ingrained in American culture that we rarely ever question it. The idea that if you stick with a company, they'll take care of you. You get the gold status, the preferred customer line, the little perks. And in the world of auto insurance, this is packaged as the loyalty discount. It even sounds nice, doesn't it? A reward for your faithfulness. But in reality, it's one of the most effective and costly illusions in the entire financial industry. It's a psychological sleight of hand designed to do one thing: make you comfortable with paying more than you have to. Let's talk about a guy named David. David is the ideal customer. He's been with the same insurance company, let's call them Patriot Auto, for 12 years. He's never had an at-fault accident. He pays his bill on time every time. And every 6 months when his renewal comes in the mail, he sees that little line item, loyalty discount, minus $75. And he feels good about it. He feels valued. This year, his total premium went up by about $90. A little steep, but hey, inflation is hitting everything, right? And besides, they're giving him that $75 discount for being such a great customer. So his net increase is only $15. He shrugs, pays the bill, and moves on with his life. David is falling for the trap. What David doesn't see is the complex algorithm working behind the scenes. This algorithm is called price optimization, and it has nothing to do with your driving record, your car, or your risk profile. It has everything to do with one single data point: your likelihood of switching providers. Insurance companies spend billions of dollars on data science to predict your behavior. They know if you visited other insurance websites. They analyze demographic data to see if people in your neighborhood, in your age bracket, with your credit profile, tend to be sticky customers. And if their algorithm flags you as someone who is unlikely to go through the hassle of shopping for a new policy, they've got you. They know they can slowly, incrementally raise your rates year after year. This is often called the loyalty penalty, or the inertia tax. They're taxing you for your own inaction. And that loyalty discount? It's the spoonful of sugar to make the medicine go down. Let's look at David's math again. His premium went up by $90. They gave him a $75 discount. He's still paying more. But the discount makes him feel like he's getting a deal. It short-circuits the part of his brain that would normally say, "Wait a minute, why did my bill go up when I haven't done anything wrong?" The discount is a tool of distraction. It's a thank you card attached to a bigger bill. Think of it this way. The insurance company has 2 buckets of customers. The first bucket is new customers. They will do almost anything to get these people in the door. They offer incredibly low, often unprofitable, introductory rates. You see their ads everywhere, promising to save you hundreds of dollars. And they can, because they're playing the long game. They get you in with a super low price, knowing that in a year or two your own inertia will kick in, and they can start the slow process of raising your rates. The second bucket is long-term loyal customers. Like David, the money they lose on those new low-price policies has to be made up somewhere. And it's made up on the backs of their most loyal customers. David's loyalty isn't being rewarded, it's being monetized. His higher premium is subsidizing the teaser rate that his new neighbor just got from the very same company. Patriot Auto isn't rewarding David for his loyalty. They're banking on it. They are betting that his 12 years of history with them, combined with the psychological comfort of a small discount, is enough to keep him from making 1 or 2 phone calls that could save him a fortune. So how do you break this cycle? How do you escape the loyalty trap? You have to be willing to do the one thing your insurance company is betting you won't. You have to be willing to leave. And you have to let them know it. This doesn't mean you have to switch every 6 months, but you absolutely must shop around every 6 months. This is non-negotiable if you want the best deal. Your renewal period is your moment of maximum leverage. Here's the playbook. It's a 2-step process. Step 1. The reconnaissance mission. 1 month before your policy is set to renew, you go on the offensive. You need to get at least 3 new quotes from other A-rated insurance companies. Not 1, not 2, but 3. This gives you a true sense of the market rate for someone with your profile. You can use online comparison tools, call local agents, whatever works for you. The key is to get real, concrete numbers for the exact same coverage you currently have. This is your ammunition. Let's say David does this. He gets a quote from Company A for $550, Company B for $520, and Company C for $500. His current renewal with Patriot Auto, even after his loyalty discount, is $750. He now has a $250 problem. More importantly, he has leverage. Step 2. The I'm ready to walk phone call. You now call your current insurer's customer service line. Not the sales line, the retention or customer service department. When they pick up, you say something very calm and very specific. Something like this. Hi, my name is David, and my policy number is 1-234-5. My policy is up for renewal next month, and the new premium is $750. I've been a loyal customer for 12 years, and I've really enjoyed my time with your company. However, I've just received a quote from another A-rated insurer for the exact same coverage for $500. That's a $250 difference, and frankly, it's just too much for me to ignore. I would much rather stay with you, but I can't justify paying an extra $250 for the same product. Is there anything you can do to match that rate or get closer to it? And then you stop talking. The silence is your most powerful tool. You have just done several brilliant things. You were polite and friendly, not confrontational. You reminded them of your long history. You showed them you've done your homework by quoting a specific, real number. And you've given them an opportunity to keep your business. You've made it clear you're not just bluffing. You have a better offer and are prepared to take it. One of 2 things will happen. In many cases, the retention specialist will suddenly find a whole host of new discounts they can apply to your policy. It's amazing. They'll click a few keys, and suddenly that $750 premium drops to $525. It might not be a perfect match, but it's a massive savings you would have never gotten otherwise. Why? Because their algorithm just reclassified you. You went from a sticky, complacent customer to a high risk of leaving customer. They would rather make less money off you than no money at all. The second possibility is they say no. They might say, "Sorry, Mr. David, that's the best we can do." And if that's their answer, your response is just as calm. "Okay, I understand. Thank you for your time and for the past 12 years of service. Please go ahead and process the cancellation of my policy for the end of the term." And then you hang up and you call Company C and you save yourself hundreds of dollars. You have to be prepared to do it. This is the only way to consistently get the best rates. Not by being loyal to a brand, but by being loyal to your own wallet. The system is designed to penalize loyalty, so you have to beat the system by demonstrating that your loyalty is up for grabs every 6 months. It's not about being cheap. It's about being smart. It's about refusing to pay an undeclared tax for your own inaction. So you've done it. You've broken free from the loyalty trap. You've shopped around, you've made the call, and you've secured a fantastic new rate that's hundreds of dollars cheaper. You're ready to sign on the dotted line and start saving. But wait, because hidden inside the fine print of that brand new, super cheap policy are a few innocent-looking clauses and coverage limits that can turn a simple fender bender into a life-altering financial catastrophe. And the scariest part is, your new agent will almost never point them out to you unless you know the exact secret questions to ask. We'll arm you with those questions next. So let's start with the single most important question you will ever ask an insurance agent. It's a question that flips the entire script on them. For their entire career, they've been trained to answer one thing. What does this policy cover? They have a rehearsed, polished, pre-approved answer for that. But you're not going to ask that. You're going to look them dead in the eye, either in person or over the phone, and ask this. Ignoring the declarations page for a moment, can you please walk me through the 3 biggest coverage exclusions or limitations in this policy that cause the most rejected claims for customers like me? Let that sink in. You're not asking what's covered. You're asking what's not covered. You're asking them to reveal the landmines. This question forces them off script. It bypasses the shiny brochure promises and cuts straight to the fine print that they hope you never read. A good agent will respect the question. A bad agent will start to squirm. They might say, "Well, everything you need to know is on the declarations page." That's a dodge. You hold your ground and say, "I understand that, but I'm asking for your expertise." In your experience, what are the hidden gotchas that people don't realize until it's too late? You are specifically asking about things like flood damage versus other water damage. Many policies cover your car if you drive through a giant puddle, but not if a river overflows its banks and floods your garage. That's an exclusion. You're asking about custom equipment. You spent $5,000 on new wheels, a sound system, and a roof rack? Great. Most standard policies cap coverage for custom parts at $1,000 or maybe $1,500. Anything more than that is on you unless you have a special endorsement. They won't tell you that. You're asking about acts of God or damage from civil unrest. These are often buried deep in the policy language. This one question is your master key. It unlocks the truth of what you're actually buying. Okay, you've opened with a bombshell. Now for the follow-up. Secret question number 2 is about a concept that is so powerful, it can literally triple your coverage for pennies on the dollar, but it's only available in certain states. You need to ask, does this state permit stacking of uninsured or underinsured motorist coverage? And if so, can you quote me the price difference between a stacked and a non-stacked policy? Let me break down why this is a million-dollar question. Let's say you have uninsured motorist coverage of $100,000. This protects you if someone with no insurance hits you and you're injured. Now let's say you have 3 cars on your policy. In a non-stacking state, your limit is $100,000, period. End of story. But in a stacking state, you can often stack the coverage for each car. So that $100,000 limit gets multiplied by your 3 cars. Suddenly, you have $300,000 in coverage. The cost to do this is usually laughably small, maybe $5 or $10 a month. It is the single best bargain in the entire insurance industry. But because it's such a good deal for you, it's a terrible deal for them. So they will almost never offer it proactively. You have to ask. And you have to use the word stacking. It's the magic word that shows them you know the game. Next up, secret question number 3. This one deals with the silent killer of your car's value after an accident. It's called diminished value. Think about it. You have a brand new $40,000 SUV. Someone runs a red light and smashes into you. The insurance company pays $10,000 to repair it perfectly. It looks brand new. But it's not. It now has an accident history on its vehicle report. If you try to sell it, you won't get the same price as an identical one that's never been wrecked. That difference in value, the value that has vanished into thin air because of the accident, is called diminished value. Can be thousands of dollars. And 99% of standard auto policies will not pay you a single cent for it. So you need to ask this very specific question. Does this policy offer any endorsement or rider for inherent diminished value claims? And if not, what is your company's official position on paying for diminished value if I were to file a claim? This question does 2 things. First, it checks if they're one of the very rare companies that actually offers a specific add-on to cover this, which would be amazing. But second, and more importantly, it forces them to state their policy on the record. Most will say they don't cover it. And that's fine. But now you know. And in some states, you can still sue the at-fault driver's insurance company for that diminished value. But knowing your own company's stance from day one is critical. It's another expert-level question that signals you are not an easy mark. Let's move on to secret question number 4. And this is for anyone with a car that's less than 5 years old. It's about the very metal, plastic, and glass they use to fix your car. You ask, does my collision coverage guarantee the use of original equipment manufacturer parts or OEM parts for all repairs? If not, what is the cost of an OEM endorsement? And are there any age or mileage restrictions? Here's the dirty secret. When your car is damaged, the insurance company wants the repair to be as cheap as possible. So they often push the body shop to use aftermarket parts. These are cheaper, copycat parts made by a third-party company. Sometimes they're fine, but other times they don't fit perfectly. They can be made of lower quality materials. And this is the big one. Using them can sometimes void your car's factory warranty. OEM parts are the real deal, made by your car's manufacturer. They are guaranteed to fit and function exactly as intended. Getting your insurance company to guarantee them is a huge win. Many companies will only guarantee them for the first year or 2 of a car's life. You need to know that cutoff. Paying a few extra dollars for an OEM endorsement can save you massive headaches and preserve the safety and value of your vehicle. Finally, we arrive at secret question number 5. This isn't a single question, it's a command. We've all been conditioned to meekly ask, "Are there any discounts I can get?" And the agent rattles off one or two obvious ones. That's the amateur hour. You're going to take control with this statement. "I would like you to perform a full discount audit on my profile. Please list every single available discount your company offers, from telematics and defensive driving to professional and alumni associations. Then confirm for me which ones are currently applied to my policy, and for any that are not, I need you to explain why I don't qualify." This is a game changer. You're not asking, you're directing. You're asking for a systematic review. You're forcing them to go through the entire checklist. You'd be stunned at what can be uncovered. There are discounts for being an engineer, a teacher, a scientist, or a first responder. There are discounts for being a member of certain college alumni groups, or even wholesale clubs. There are discounts for having anti-lock brakes, daytime running lights, or a factory-installed anti-theft system, things most modern cars have, but are often missed on a policy. By demanding a full audit, you're forcing transparency. They can't just cherry-pick the easy ones. They have to go line by line. This process alone can easily save you another 10 to 15%. These 5 questions are your sword and your shield. They are designed to cut through the fluff and expose the truth of a policy. They move you from being a price taker to a value negotiator. You're no longer just comparing the headline price. You're comparing the real, tangible coverage that will be there for you when the worst happens. Now you have the intelligence, the secret questions that unlock the hidden truths of any auto policy. But knowing what to ask is only half the battle. The other half is knowing how to use the answers. It's knowing how to counter their objections, how to parry their scripted deflections, and how to use their own psychology and business metrics against them to get what you want. It's one thing to have the ammunition. It's another to be a skilled marksman. And that's exactly what we're going to do next. We're going to turn you into a master negotiator. And the first rule of master negotiation is to control the frame of the conversation before you even dial the number. Most people go into this call with the wrong mindset. They think it's a confrontation. They're nervous, maybe a little defensive, and they see the agent on the other end of the line as an obstacle, a gatekeeper to the lower price they want. This is a fatal mistake. The agent is not your enemy. The agent is your most powerful potential ally. Their job is to sell and retain customers. They have quotas to meet, and keeping a good, low-risk driver like you is a massive win for them. Your goal is not to fight them. It's to make it easy for them to give you what you want. You are a team working together to find a price that keeps you a valuable customer with their company. Once you shift your mindset from confrontation to collaboration, everything changes. You're no longer asking for a handout. You're co-creating a solution. So, you have your competitor quotes in hand. You've done your homework. You pick up the phone. When you get a licensed agent on the line, you start with politeness and a clear goal. Something like this. "Hi, my name is your name, and my policy number is your number. I'm calling today because my policy is up for renewal, and the new premium is a bit higher than I was expecting. I've been a loyal customer for a number of years, and I'd really love to stay with you. So I was hoping you could help me find a way to make the numbers work." Look at what you just did. You were polite. You stated your loyalty. You framed the goal as staying with them, which immediately puts you on the same team. You didn't demand or threaten. You asked for help. This simple opening completely changes the dynamic of the call. Now comes the most critical moment in the entire negotiation, the anchor. In psychology, anchoring is a cognitive bias where we rely too heavily on the first piece of information offered when making decisions. Car dealerships are masters of this. They throw out a high manufacturer's suggested retail price to anchor your expectations, so when they knock a few thousand off, it feels like a huge discount, even if you're still overpaying. We're going to use this same principle, but for good. You must be the one to set the anchor. Do not ask, "What's the best you can do for me?" If you do that, they will set the anchor, offering a tiny pre-approved 5% discount, and you'll spend the rest of the call fighting uphill from their number. Instead, you set the anchor using your research. After your polite opening, you say, "To give you an idea of what I'm looking at, I have a quote here from Progressive for the exact same coverage, and they're coming in at the lowest competitor's price. As I said, I've been with you for a number of years and I'd much rather stay, so my goal is to see how close you can get to matching that." Boom! The anchor is set. The entire conversation is now framed around that competitor's number. You've taken control. You're no longer begging for scraps off their price. You're inviting them to match a real, tangible offer that you have on the table. This is the difference between playing checkers and playing chess. The agent will now go to work. They'll put you on hold while they see what they can do. When they come back, they will likely have an improved offer, but it probably won't match your anchor price. They might say, okay, I was able to apply a couple of discounts and I got your premium down to their new lower price. This is where amateurs say, okay, thank you, and lose hundreds of dollars. But you're not an amateur. This is just the second move in the game. Your response is calm, appreciative, but firm. Thank you, I really appreciate you doing that. That's definitely a step in the right direction. It's still quite a bit higher than the competitor's price I have here. Can you tell me which discounts are currently on my policy? I want to make sure we haven't missed anything. Now you're opening up the playbook. You're not just talking about the final price, you're talking about the components that make up the price. This is where you bring out your list of discounts. Okay, I see you have the multi-policy discount. That's great. I also recently completed a defensive driving course online. Can we add that discount? And my son is on the policy and he has a 3.8 GPA. Are we getting the good student discount for him? Also, I've been working from home 3 days a week, so my annual mileage is down by about 40%. Can we adjust that on the policy? I believe that should make a significant difference. You are systematically deconstructing their price and rebuilding it in your favor. You're not being pushy. You're being thorough. You're reminding them of your value and ensuring you're getting credit for it. Each one of these is a legitimate reason for your rate to be lower. You're making it easy for the agent to justify the price drop to their manager and their system. At this point, you might encounter some resistance. The most common line you'll hear is, "I'm sorry, but that's really the best price the system will give me." This is a script. It's designed to make you give up. It is almost never true. Your response is the key. You stay polite, you stay collaborative. I completely understand that your system has its limits, and I appreciate you trying. I know you've done what you can. Given that I have a written offer that's substantially better and I've been a customer for so long, is there a senior agent or someone in the customer retention department who might have a little more flexibility to approve a price match? I want to exhaust every option to stay with you before I make a final decision. This is the polite escalation. You're not questioning the agent's competence. You're acknowledging their limitations and asking to speak to someone whose specific job it is to save customers like you. The phrase customer retention is a magic key. It unlocks a new level of negotiation. These specialists have one job: keep you from leaving. They have access to discretionary discounts and loyalty bonuses that regular agents often don't. More often than not, the first agent will suddenly find a little more flexibility themselves rather than pass you up the chain. Now let's talk about a secret weapon, one used by the world's best FBI hostage negotiators: the power of silence. After you've made your point, for example, after you've asked to speak with the retention department, just stop talking. Don't say a word. Let the silence hang in the air. It will feel awkward for about 5 seconds, and then it will feel excruciating for the person on the other end of the line. We are socially conditioned to fill silence. They will feel an overwhelming psychological need to speak, to fill that void. And very often, they will fill it with a concession. They'll say, "Well, let me just check one more thing." That one more thing is often the discount you were looking for. Use it. After you make a strong point, take a breath and say nothing. Count to 10 in your head. It is one of the most powerful and underutilized negotiation tactics on the planet. Finally, remember your goal. Your goal is not necessarily to get them to match the lowest price to the penny. Your goal is to get the best value. If they can get within $5 or $10 a month of the competitor, and you genuinely like their service, that's a huge win. You've just saved hundreds of dollars for a 15-minute phone call. If you reach a final offer and you're happy with it, take it. That's perfect. Thank you so much for all your help with this. I really appreciate you taking the time to make it work. Let's go ahead and lock that in. And what if they absolutely won't budge? What if their final offer is still way too high? You don't get angry. You don't burn the bridge. You leave the door open for the future. You say, "Okay, I really want to thank you for your time and effort on this. I appreciate it. That price is just too far off from what I'm being offered elsewhere for me to justify it right now. I'm going to have to go with the other offer. But I'll definitely keep you in mind for next year." Why do this? Because insurance companies track this. They know they lost a long-term customer over price. And guess what you're going to get in the mail in 6 to 9 months? A "We want you back." offer that will be incredibly aggressive. By being firm but polite, you've won the battle today by switching, and you've set yourself up to win the war next year by being welcomed back with an even better deal. This is how you play the long game. You are now in complete control of your insurance costs, not just for this year, but for every year to come. But there's one more piece to this puzzle: a new type of insurance that's completely changing the game for good drivers, and a final strategy to make sure you're never, ever overpaying again. That new type of insurance is called usage-based insurance, or UBI. You might know it by another name, telematics, and it represents the single biggest shift in the auto insurance industry in the last 50 years. For decades, insurers have been playing a guessing game. They looked at broad impersonal data points: your age, your zip code, your credit score, the type of car you drive, and used them to predict how likely you were to get into an accident. It was a system of averages and assumptions. If you were a 21-year-old male, you were automatically a high risk, even if you drove like a saint. If you lived in a dense urban area, you paid more, even if your car sat in a garage 29 days a month. It was frankly an unfair system. It penalized people based on demographics they couldn't control. But telematics changes the entire equation. Instead of guessing how you drive, it knows how you drive. It uses technology, either a small device you plug into your car's diagnostic port or an app on your smartphone, to gather real-world data about your actual driving habits. It's no longer about who you are on paper, it's about who you are behind the wheel. And for safe drivers, this is the key to unlocking discounts that were previously impossible to get. So what exactly is it tracking? This isn't some black box spy device listening to your conversations. It's focused on a few key metrics that are highly correlated with accident risk. The first is braking. Are you constantly slamming on your brakes? This suggests you're following too closely or not anticipating traffic, both hallmarks of a risky driver. The second is acceleration. Are you peeling out from every stoplight? This aggressive behavior is a major red flag for insurers. The third, and a big one, is the time of day you drive. Statistically, driving between midnight and 4 a.m. is significantly more dangerous due to factors like fatigue, lower visibility, and a higher prevalence of impaired drivers. The fourth is mileage. This one is simple. The less you're on the road, the lower your risk of being in an accident. And finally, some of the more advanced smartphone-based programs can even detect phone usage while the car is in motion. Now, when you hear tracking, the alarm bells of privacy might be going off in your head, and rightfully so. It's a valid concern. But let's be clear about what's happening. Insurers are not interested in where you're going. They don't care if you're going to the grocery store or a secret rendezvous. They are interested in the patterns of your driving. The data is aggregated and anonymized, focused purely on risk assessment. Furthermore, you are in control. This is an opt-in program. You are consciously choosing to share this data in exchange for a potentially massive discount. And the discounts can be truly significant. We're not talking about 5%. Many drivers see discounts between 10 and 30%. For a family with an annual premium of $3,000, that's up to $900 back in your pocket every single year. Imagine you're a college student who lives on campus. You barely drive, and when you do, you're cautious. Under the old model, your age automatically puts you in a high-risk, high-cost bracket. With telematics, you can prove the assumptions wrong. You can provide concrete data that shows you're a low-mileage, safe driver, and your premium can be slashed dramatically. Or maybe you're a recent retiree. You're no longer commuting 2 hours a day in rush hour traffic. Your driving is now limited to local errands during off-peak hours. Telematics allows your insurance rate to finally reflect that new lower-risk lifestyle. However, this isn't a magic bullet for everyone, and this is critical to understand. Most programs offer an initial discount just for signing up, but the final rate depends on your driving score. If you have a lead foot, if you're a chronic late breaker, or if you work the night shift and do most of your driving in the early morning hours, a UBI program could actually backfire. Some, though not all, programs reserve the right to increase your rates if your driving data shows you're a higher risk than they initially thought. So, you need to be honest with yourself. If you know you're an aggressive driver, this might not be the program for you. But if you genuinely believe you're a safe, conscientious driver, you are essentially leaving money on the table by not exploring a telematics option. You are letting your insurer charge you based on the bad habits of your demographic neighbors, instead of the good habits you practice every day. This brings us to the final strategy, the one that ties everything together and ensures you are never, ever taken for granted by your insurance company. I call it the annual insurance checkup. So many people make the mistake of set it and forget it with their auto insurance. They sign up, put the payments on auto draft, and don't think about it again for 5, maybe 10 years. This is a colossal financial error. The insurance landscape is constantly changing, your life is constantly changing, and companies reserve their best rates for new customers, not loyal ones. Your annual insurance checkup is a simple, non-negotiable appointment you make with yourself 1 month before your policy is set to renew. Put it in your calendar right now for next year. During this checkup, you do 3 things. First, you review your life. What has changed in the last year? Did you get married? That's a discount. Did you move to a safer zip code? That's a discount. Did you start working from home and slash your commute from 50 miles a day to 0? That's a massive discount. Did your teenager who was on your policy finally move out and get their own insurance? You have to tell your insurer these things. They will not proactively call you to offer you a lower rate. You are your own best advocate. You must report positive life changes that reduce your risk profile. Second, you review your coverage. Your needs are not static. That brand new car you bought 3 years ago now has 70,000 miles on it. Do you still need collision and comprehensive coverage with a tiny $250 deductible? Maybe raising that deductible to $1,000 could save you hundreds a year. A risk you're now willing to take on a depreciated asset. Conversely, did you get a big promotion at work? Your assets have grown, and that state minimum liability coverage you bought when you were just starting out is now dangerously inadequate. A single at-fault accident could expose your savings, your investments, even your home. Your annual checkup is the time to right-size your coverage for the life you have today, not the life you had years ago. And third, and most importantly, you reshop your policy. Every single year. No exceptions. You take your updated life information and your current coverage needs, and you run the gauntlet. You go back to those independent agents. You check the online quote aggregators. You go directly to the websites of the big direct-to-consumer carriers. And this time you ask about their telematics and UBI programs. You get a full spectrum of quotes, from traditional models to usage-based ones. You might find that your current insurer is still competitive. More often than not, you'll find that another company is willing to offer you the exact same coverage for significantly less, simply to win your business. This process doesn't need to take more than a couple of hours, but those 2 hours could easily save you $500, $1,000, or even more. It's the highest paying part-time job you will ever have. By combining a deep understanding of discounts, leveraging your credit, optimizing your coverage, exploring the new frontier of telematics, and committing to an annual review, you build a bulletproof system. You are no longer a passive customer accepting whatever rate is given to you. You are an active, educated consumer who is in complete control of one of your biggest household expenses. But even with this entire system in place, there is one final trap. A moment where all your hard work can be undone. It doesn't happen when you're buying insurance, but when you desperately need to use it, the moment you file a claim. There is a catastrophic mistake that 99% of people make in the chaotic minutes and hours after an accident. A mistake that can lead to a lowball offer, a denied claim, or even getting your policy canceled altogether. And in the final part of this series, I am going to reveal exactly what that mistake is, and give you the word-for-word script to make sure you never, ever make it. The single biggest mistake you can make is what you say in the first phone call with an insurance adjuster after an accident. This one conversation, often recorded and legally binding, can single-handedly decimate the value of your claim. The mistake isn't lying. It's being honest in the wrong way. It's being human. It's saying things like, "I'm so sorry," or "I just looked away for a second," or "I think he was going pretty fast." You have to understand, the moment you get into an accident, your relationship with your insurance company fundamentally changes. They are no longer just the company you pay every month. They are now a business with a financial interest that is directly opposed to yours. Your goal is to be made whole, to get the maximum amount you are entitled to under your policy. Their goal, from a business perspective, is to minimize their payout. The person on the other end of the line, the adjuster, might sound friendly, they might sound empathetic, but their job is to find reasons to reduce the value of your claim. They are trained professionals in the art of conversation, skilled at getting you to say things that introduce doubt, ambiguity, or even partial fault. When you're on the phone minutes or hours after a crash, you're flustered. You're full of adrenaline. You're not thinking like a lawyer. You're thinking like a person who just went through a traumatic event. And they know this. They want to get you on a recorded line in that state of confusion. Every Every I guess, every maybe is a potential crack they can exploit. If you say, "I'm not really hurt, just a little sore," they document it. If that soreness later turns out to be a serious whiplash injury that requires months of physical therapy, your own words will be used against you to argue that the injury wasn't a result of the accident. If you say, "He came out of nowhere," they can interpret that as you admitting you weren't paying attention. This is the moment where thousands, or even tens of thousands of dollars are won or lost. And you win by controlling the information. You win by refusing to play the game on their terms, in that initial high-pressure phone call. You need to be polite, you need to be cooperative, but you do not need to give a spontaneous recorded statement. So what do you say? Here is the word-for-word script. Memorize it. Put it in the Notes app on your phone. Put a copy in your glove box next to your registration. Because when you need it, you won't have time to think. When the adjuster calls and asks for a recorded statement about what happened, you take a deep breath and you say this: "Thank you for calling. I am only going to provide the basic information needed to open the claim right now. I am not prepared to give a recorded statement at this time. Are you ready for the basic details?" That's the opening. It is polite, firm, and it immediately establishes control. You've set the boundary. They will likely agree and ask for the info. Here is what you provide and only what you provide. The incident occurred on date at approximately time. The location was intersection or address. My vehicle involved is a year, make, model. A police report was filed. The report number is. Provide the number if you have it. Please send me a copy of that report, along with all the necessary claim forms I need to fill out. What is the best email address to send my future correspondence to? And can you please give me my claim number? Let's break down why this is pure genius. First, I am not prepared to give a recorded statement at this time. This is the critical phrase. It's not confrontational. It's not a refusal. It's a postponement. You are signaling that you will cooperate, but on your own timeline after you've had a chance to calm down, gather your thoughts, and review the official police report. You have every right to do this. Second, you stick exclusively to the verifiable facts. Date, time, location, cars involved. You offer zero opinions, zero speculation, zero emotion. You don't talk about speed or weather or what you were doing. You don't say who you think was at fault. You state facts. Third, and this is the checkmate move, you say, "A police report was filed." This is incredibly powerful. You are deferring the story of what happened to an official, third-party document created by a law enforcement officer. You're not telling your version of the story. You're pointing them to the official version. This makes it much harder for them to poke holes in your account. Finally, you end by taking control of future communication. Please send me all necessary forms. What is the best email address for future correspondence? This moves the conversation from the verbal arena, where you are at a disadvantage, to the written arena, where you have all the power. Communicating via email is a game changer. It creates a paper trail of every single interaction. There can be no dispute about who said what. It forces the adjuster to be clear and concise. And most importantly, it gives you time. Time to read their questions carefully. Time to formulate your answers. Time to review your policy and the police report before you respond. You would never sign a legal contract without reading it. Why would you give a legally binding verbal statement without preparing for it? Now, what if they push back? They almost certainly will. The adjuster might say something like, "Well, we can't really move forward with the claim until we have your statement." Or, "It's just a few simple questions, it will only take a minute." They are trying to make you feel like you are being uncooperative or delaying your own payout. Do not take the bait. You simply calmly repeat the core message. You can say, "I understand, and I will provide a full detailed account. I am simply not doing it on a recorded call today. Please email me the forms and the police report as requested, and I will provide all the necessary information in writing. I want to ensure I give you the most accurate information possible." This language is perfect. It frames your refusal as a desire for accuracy, which is something they cannot argue with. You are not being difficult, you are being diligent. By mastering this simple script, you fundamentally shift the power dynamic. You go from being a flustered victim to a prepared, methodical, and savvy consumer. You prevent them from using your own words against you and ensure that your claim is based on the official facts of the case, not on a panicked, emotional recollection. This single strategy is the most powerful tool. You have to protect yourself from a lowball offer or an unfair denial. It ensures you get every penny you are owed. And that brings us to the end of our journey together. Over these 10 parts, we've pulled back the curtain on the entire auto insurance industry. We started by decoding your policy, making you an expert on liability, collision, and comprehensive. We moved on to stacking coverages and understanding the vital role of uninsured motorist protection. We uncovered every possible discount, from the simple ones like paperless billing to the advanced strategies of using telematics and driving monitors to prove you deserve a lower rate. We built a bulletproof strategy for shopping, using independent agents and online aggregators to force companies to compete for your business, saving you hundreds, if not thousands. We armed you with the exact negotiation tactics to use on the phone, turning their own retention departments into your personal discount engine. And finally, we just gave you the ultimate tool to protect yourself when it matters most during a claim. You are now in the top 1%. You know more about auto insurance than the vast majority of drivers on the road. You have the knowledge and the tools to not just save money, but to be properly and truly protected. This isn't just about a car. It's about your financial security. My only request is that you don't keep this knowledge to yourself. The system is designed to profit from confusion. The best way to change that is to spread clarity. Think of one person right now, your son or daughter who just got their license, your friend who is struggling with their budget, your parent who has been with the same company for 30 years. Send them this video series. Empower them the way you've been empowered. Because being smart with your money isn't just about finding ways to earn more. It's about being fiercely protective of what you already have. Thank you for your time and your trust. Drive safe, stay savvy, and I'll see you in the next video.